welcome. You're watching the Global Reset on CNBC TV18 Prime with me, Surabhi Upadhyay. The big headline that we are tracking today, US President Donald Trump has threatened to increase tariffs on India within the next 24 hours. In an exclusive interview with CNBC, Trump said, and I quote, "I think I'm going to raise India's tariffs substantially in the next 24 hours." End of quote. Now, that's not all. President Trump has raked up the Russian oil issue yet again and accused India of fueling Moscow's war machine. On Monday, in a post on Truth Social, Trump, while announcing that he would impose substantially higher tariffs on India, had criticized New Delhi for financing Russia's war in Ukraine by buying what he called massive amounts of Russian oil. The Ministry of External Affairs has, of course, already hit back, calling the targeting of India unjustified and unreasonable. India has promised to take all necessary measures to safeguard national interests and economic security. Let's listen into Trump's latest tariff rhetoric against India.
With India, what people don't like to say about India, they're the highest tariff nation. They have the highest tariff of anybody. We do very, very little business with India because their tariffs are so high. So India has not been a good trading partner because they do a lot of business with us, but we don't do business with them. So we settled on 25%, but I think I'm going to raise that very substantially over the next 24 hours because they're buying Russian oil, they're fueling the war machine, and if they're going to do that, then I'm not going to be happy. But India went from the highest tariffs ever. They will give us 0 tariffs, and they're going to let us go in. But that's not good enough because of what they're doing with oil.
There you go. He's saying he's not happy, and what India is doing, even if it's 0 tariffs, will not be enough because of the Russian oil purchases. Now, in the meantime, New Delhi has called the targeting of India unjustified and unreasonable. Government sources say that India is not the quote-unquote tariff king, as claimed by the US president, citing data from WTO, which shows India's weighted average tariff is actually less than Europe, Vietnam, Bangladesh, among several other countries. We have Parikshit joining in with the latest report.
And President Trump has been repeatedly claiming India is the tariff king, while data shows India's tariffs are high. When considered at face value, the weighted average of the tariff levies is much lower than several countries. Sample this. India's simple average is less than 16%, but India's weighted average applied tariff rate is just 4.6%. This gap shows that higher tariffs are concentrated in a few low import sectors like agriculture and automobiles, which form a small share of the trade between India and the US. India's trade weighted average rate of 4.6% is lower than the European Union's 5%. Developing economies like Vietnam and Indonesia are also well above India's rate. The rate for Bangladesh is over 10%. Since January this year, India has made several concessions to strike a deal with the United States. Harley-Davidson motorcycles, for example, in India are now cheaper after duties were reduced from the earlier 50% to around 30%. Similarly, tariffs on bourbon whiskey has been cut from 150 to 100%. These were two of the many tariff measures India undertook to sweeten the deal. That's not all. India abolished a 6% equalization levy, which was applicable on US tech firms offering online services in India. Additionally, retaliatory tariffs on key American agricultural exports like apples, walnuts and almonds were withdrawn in 2023 after the resolution of WTO disputes. India has also been increasing its energy imports from the US. In the first quarter of this financial year, US energy imports are up 114%. The share of US crude in India's import basket has risen from 3% to 8%. In July alone, India is estimating a 150% rise in energy imports from the US. This year, responding to the US president, the Ministry of External Affairs has said the targeting of India is unjustified and unreasonable. It promised to take all necessary measures to safeguard national interests and economic security. India also defended its oil imports from Russia, saying it began importing from Russia because traditional supplies were being diverted to Europe after the Ukraine war. India has also gone on to say that the US actively encouraged India to import Russian oil, as that would strengthen the global energy market stability. This was because of a sharp spike in oil prices, with Brent crude hitting $137 per barrel in March 2022 after Russia invaded Ukraine. In November 22, U.S. Treasury Secretary Janet Yellen had said, and I quote, the United States is happy for India to continue buying as much Russian oil as it wants, including at prices above a G7 imposed price cap mechanism, if it steers clear of Western insurance, finance and maritime services bound by the cap. End of quote. Just a few months ago, in May 2024, U.S. Ambassador to India Eric Garcetti admitted that India bought Russian oil because the U.S. wanted someone to buy Russian oil, and the U.S. allowed these purchases to ensure oil prices do not go up globally. End of quote.
Okay, so there you go. The push and pull over not just tariffs, trade deficits, but also now it's about Russian oil. So let's discuss this and the way the setup is placed. We have Manpreet Gill, CIO, Africa, Middle East and Europe at Standard Chartered, joining in to take some questions. Manpreet, great to have you on. Thank you for joining in. So it's a standoff that I think many were not anticipating entirely. And there seems to be no backing down from either side, at least at this point in time. Your first thoughts on whether you see this as, maybe more negotiation, more tactics, or could 25% indeed be a reality?
Morning. Look, I think what makes it hard is that what we can say from a market perspective is that uncertainty is high. And to your point, whether this is part of a bargaining process or where we might end up is very difficult to say at face value. But I think this is where we can draw some lessons of the past 3 months, right? I think what we have learned is that you can have quite a bit of uncertainty in the short run. Things can change day to day, but that's not necessarily a good indicator of where a trade deal or may finally and ultimately end up. And that's why what's going on today, as a market investor, I look at the lens to heighten uncertainty rather than reaching any sort of end conclusion. What it does mean, though, is that as investors, we need to not necessarily place a view on an outcome sort of achieving one way or another. But one approach we taken sort of before April 2nd was to really focus more on domestic sectors as opposed to sectors that are more sensitive to where trade negotiation might go. And sort of that we think may be a better way of dealing with what we view as uncertainty rather than sort of trying to draw a conclusion from comments that are, could go either way.
Absolutely, uncertainty is the word, though, the 7th of August is when these tariffs are supposed to go into effect. That's when the U.S., as Mr. Trump says, starts collecting huge amounts of money. So we don't have too much time before that. Also, what remains very uncertain is the so-called penalty that Trump is speaking of, which he intends to impose on India for buying Russian oil. But he was asked this question, saying, what will this penalty be? Will it be in the form of some sanctions? What does he have in mind? Well, he didn't have very clear answers. Listen in.
Well, I never said a percentage, but we'll be doing quite a bit of that. We'll see what happens over the next fairly short period of time. But we'll see what happens. Yep. They have a meeting tomorrow. We have a meeting with Russia tomorrow. We're going to see what happens. We'll make that determination at that time.
Okay, so he's also going to meet the Russians. Will there be some breakthrough? Well, the market remains on tenterhooks. But Manpreet, coming back to the market and sort of making sense of all of these moving parts, you actually have a fairly constructive view, right, on many Asian markets, the Asia ex-Japan region. And I believe India continues to be a core market for Standard Chartered?
Absolutely. And I think what we're trying to do here is that, look, we don't expect this to happen without volatility. One of the points we made is as the 90-day pause expired, we should expect some volatility in this sort of day-to-day uncertainty. But I think our point is more that when we look through over the course of the next 6 months or so, it's important to more dispassionately weigh the positives with the negatives. So yes, we know growth is under some pressure, and tariffs, we don't know where they're going to ultimately end up. But one of the cornerstones of our mid-year view also is that we think all of this trade pressure will ultimately lead to a weak US dollar. And in the bigger picture, we know environments of a weak US dollar tend to be really good for capital flows into emerging markets, the outperformance of equities, and more importantly, the outperformance of non-US equity markets. And that's really where a lot of our positivity comes from. That's really why, in terms of our overweights, we moved our overweight away from US equities towards Asian equities. And within Asia, yes, we can debate whether the outperformance come from North or North Asian equities, China, Korea, or from India. But that backdrop actually is a more positive one. So yes, we need to go through this period of uncertainty. We need to assess where sort of the tariff picture might land. But once you start looking through that, we think, the avoidance of a recession in the US and what we think would be a weak dollar, those actually tailwinds rather than headwinds. And that's really where our constructive stance is coming from.
Manpreet, here in India, of course, we know the numbers too well, that exports to the US, goods exports that is, only comprise 2% of GDP. So it's not huge. And even when we talk about as a percentage of India's market cap, it impacts smaller segments. I mean, areas like textiles, gems and jewelry. Pharma is still, hanging in balance. We'll come to that in a minute. But there's still when we talk to companies here, they talk about second order effects. We're speaking to a capital goods company, a company that makes boilers. And they were saying that it's a little difficult because many of their clients from, say, the pharma space or the chemical space or even textiles, the whole decision-making process is now getting elongated. So will this cast a longer shadow on Indian equities if the standoff continues on trade with the US?
I mean, yes, one would expect there to be some second order effects. I think that would be only natural. And I think where it ultimately comes back to the market is trying to get an assessment, okay, where does that ultimately leave economic and earnings growth, right? So in the short term, at least until we get a resolution, this uncertainty is likely to be a bit of an overhang. And that is one of the reasons why, relatively speaking, within the region, for the time being, our overweights were more skewed towards North Asia and markets, which perhaps weren't pricing in as much good news. But I think what it comes to from Indian equities, once we look through this, I think that's where two factors, I think, are where I sort of take the positivity. One is from a sector perspective, that's part of the reason why we try to focus on sectors that have a more clearer domestic focus. So financials, consumer discretionary, relatively speaking, should see less of those impacts, at least directly. And second is, look, we need to balance that with how much of a growth slowdown might already be in the price. Because let's not forget, investing is not only about the absolute outlook, but relative to what uncertainty is already well known. So I think the fact that we've been debating earnings growth for quite some time and pricing that in, I think that's a silver lining. I think the fact that we've got more sort of policy support, whether that's from RBI rate cuts or earlier through the budget, I think that's another silver lining. So we need to get to this period of uncertainty, no doubt. I think we should prepare for a little bit of short-term volatility, but I think we should equally balance that with keeping an eye on the long-term ball.
And would you sort of have a target on the local index here, the Nifty, or I would say next 12 months? What's the kind of upside on Indian equities that you expect?
Well, we try not to think in terms of targets specifically, but at the end of the day, where an overweight comes from is saying, look, can I do better investing in equities relative to sitting in bonds and cash? That's the most important point. So our return expectations are undoubtedly more moderate compared to, the more heady days looking back a couple of years ago. But I think if we get something in the region of even, average long-term returns, high single-digit returns, early double-digit, that would still be a good outcome because, it still would leave equities a better place to be compared to owning, mid to long duration bonds or just sitting in cash, which is what, tends to be the knee-jerk reaction when you have uncertainty. So that's why our approach is to say, look, let's expect some volatility, but if we do get pullbacks, those are pullbacks we'd be happy to buy into, because once we get through this, what happens, if we do get weak dollar or a less worse outcome than what markets might be fearing today, we just think that will be enough from a driver's perspective to push equities to do much better than the next best alternatives.
No, absolutely. And when it comes to tariffs, what's also brought things into such a sharp light is the departure from where we were in April, where when he first held that placard on the White House grounds, India was actually being hit with the lower tariff level than a lot of the ASEAN economies. But now things are very different. In fact, we're talking about 15% being the tariff rate for EU, for markets like Japan, for South Korea, 20% for Vietnam. And in stark contrast, India really stands out. In fact, we know that Manpreet and his team is fairly optimistic on some other Asian markets like China, like South Korea. So let's do one thing. Let's listen into what the US president had to say on the next steps with respect to a trade deal with China.
A meeting with China? No, I don't want it. No, he asked for a meeting, and I'll end up having a meeting before the end of the year, most likely, if we make a deal. If we don't make a deal, I'm not going to have a meeting. I mean, what's the purpose of meeting if we're not going to make a deal? But we're getting very close to a deal. We're getting along with China very well. I will tell you, you had a point when I had 145% tariffs on. I put in for fentanyl. I actually said to people, where are we now with China, by the way? Because I kept adding more and more. They said, sir, you're up to 145%. I said, you got to be kidding. So I sort of had to bring it down a little bit. But when it was up to 145%, meaning we were doing zero business with China, China was collapsing. I don't know if you know that. You haven't reported it if you do. But China was collapsing. China is very reliant on the United States. My relationship with him is very good. I think we'll make a good deal.
Okay, well, he says China was collapsing. The Chinese have been saying otherwise because they didn't back down and said that negotiations cannot happen till that 145% is rolled back, and then it was rolled back, at least partially. Manpreet, China, actually both these markets, South Korea and China, they've been drawing in a fair amount of foreign interest and action. How do you view them?
Well, within the region, those are our preferred markets at the moment. But I think, look, the rationale for that is also a very different starting point, because let's not forget that, while there has been a fair amount of optimism and reasonably stable optimism about India's growth outlook, Chinese equities in particular, going back the last couple of years, were under some pressure from a much more concerning growth outlook, and that's where we saw markets have rallied from a much more inexpensive valuation starting point. So I think that's one factor that's really helped. And the second, of course, is when you tend to get cyclical, strong cyclical rallies, you tend to see markets like in North Asia, particularly Korea, which tend to outperform over short periods of time. So those are the two drivers I think we're really sort of basing our overweight on. But that's, of course, something we have to review month to month, right?
Yeah.
And I think we've obviously got some strong gains today. I think the comments you put on earlier just drive home the importance of just taking a cooler and longer-term view of these, right? Because to Trump's point, 3 months ago, a lot of the extreme tariff pressure was on China. Today, we seem to be in a different place with the rallying markets. And it just speaks to the uncertainty of the process. But I think our preferred approach is to really try and look through that short-term volatility, which we know is inevitable. We can't predict where this will ultimately land, but I think what we can predict is just ultimately how the other more fundamental factors might evolve, and really plan around that and plan around what's visible.
A fair point, but just leaving tariffs aside for a second, Manpreet, if we just look at intrinsically what's happening with both these economies, China as well as South Korea, what's your take then? Tariffs is one piece and where that number finally settles, but intrinsically, for instance, look at the EV sector. There's been a complete price war out there. There's still big tech in China that seems to be causing a fair bit of flutter. And then all the efforts of getting domestic consumption firing. Do you think the efforts the Chinese are making are actually succeeding on some of these fronts?
Well, on several fronts, yes, but I think that's where policy stimulus has and continues to play a pretty important role, right? Because whether you take a sector-based perspective or you take a more macro perspective, looking at some of the deflationary pressures, by themselves, you might say there's some concern, but we have seen some stabilization in some of the more high-frequency growth data. And that's really coming from the fact that in China, we've seen the steady trickle of stimulus, both from a monetary front, but increasingly more recently from a fiscal front. And when we talk about some optimism, I think policy support is absolutely one cornerstone of that. And look, I think in China's economy, for example, still faces many growth headwinds. The stability is happening at a relatively slower level, and some of the very low inflation numbers are still something I'm sure policymakers are all over. But at the end of the day, we're trying to balance that with where markets are and what they were pricing, right? And I think as an investor, you ultimately have to balance the two. We think the fact that policy support is coming through is what will ultimately tip the scales. And similarly in Korea, right? I think what's really unlocked some of the value there is that markets were extremely inexpensive for a long period of time. So while the growth outlook was somewhat tepid, markets were more than pricing that, and all it took was some sort of public commitment to help shift policies to unlock some of that value. So it's about balancing the two. I think that's where the near-term sort of positivity and preference on North Asia comes from. But I think policy stimulus, whether you're looking at North Asia or indeed what may be in store for Indian markets, I think is going to be an equally important part of the mix looking out over the next 6 to 12 months.
Okay, absolutely. So that's a view on China, but for the time being, obviously, it continues to find traction when it comes to foreign investments and foreign flows. We need to take a very quick break. We'll come back on the other side, continue this conversation, and also the next major sector on which these ominous tariff clouds are hovering is pharmaceuticals here in India. We'll talk about that on the other side. Welcome back. You're with us on the Global Reset, and today we're discussing all the tariff threats that keep coming towards India's way from the US president. Now, aside from saying that he will substantially hike the 25% tariff rate and put penalties on India because of buying Russian oil, Trump is also saying that he can be raising pharmaceutical tariffs, pharma imports coming into the US, by as much as 250%. Listen in.
Pharmaceuticals will be putting a initially small tariff on pharmaceuticals, a half year's maximum. It's going to go to 150%, and then it's going to go to 250% because we want pharmaceuticals made in our country.
Okay. Now, that's the latest missive. Manpreet, comment on this, because in terms of, large export sectors, pharma is very, very sensitive. Now, we don't know how much of this really comes through, or if this is one of those, taco moments, as the market says. But, would you be suggesting that investors lighten up their positions on, say, Indian pharma because of the environment we're in?
Well, I think you're right. The reality is we don't know whether this is part of a broader bargaining process, whether that can be fully followed through. And hence it comes at the point about all we know is that we're in a period of elevated uncertainty for the time being. Look, I think in terms of sort of sector exposure, I guess given that imminent threat, perhaps that wouldn't be the first place I'd look from a short-term perspective. I think what we've learned, of course, through many decades of market history is that when you're looking for some relative safety, while healthcare gets normally sort of a safe haven sector, each safe haven fails in a particular instance, and this might very well be an example of that. But I think if the goal is to insulate or build some protection from tariff threats, then the only way to do that is to focus on, as domestic and non-trade exposure as possible. And I guess pharma and healthcare more broadly will not provide that. And that's where I guess a preference for something like consumer discretionary really comes from. There may be no perfect, 100% domestic exposure, but I think if you're looking for insulation from domestic threats, from trade tariffs, then focus on domestic would be our first port of call, whether you do that from a sector perspective or a greater focus on areas like mid-cap, for example.
All right, got it. So, Manpreet, now putting it all together, we've discussed obviously several markets in the region. We've discussed some specific sectors that could be hit in India as well. But putting it all together, what's the sense you get when you speak to investors and colleagues across the region? Are they seeing this as a reset or a slight setback in the India-US relationship, A? And if that is the case, would foreign investors look at India a little differently in the very near term?
Well, I think from a foreign investor's perspective, let's not forget that while there was a lot of headline optimism, I think there wasn't a lot of actual foreign investor buy-in into the optimism on Indian growth for quite a long period of time. And some of that, of course, might be related to the uncertainty around trade. Some of it, in our view, was as simple as the fact that the US dollar was very, very strong until the late last year. So I think, look, we know these things tend to go in cycles. I think we're coming off a period when there was quite a bit of optimism on the Indian growth outlook. And of course, in recent quarters, we've seen a little bit of a reset against that. As investors, I think the most important thing is to make a more level-headed assessment and try to always lean against, extremes in sentiment. So for us, yes, in the short term, that means it's quite possible. We experience a bit more volatility. But I think for us, the most important thing from a foreign investor's perspective, which has worked consistently through history, is to keep a sharp watch on the US dollar. Because if we really do see, weak US dollar prevail as we expect over the next 6 months and indeed beyond that, then yes, uncertainty can create short-term hits to sentiment, but ultimately foreign investors are more likely than not to add, exposure to emerging market assets, particularly if they're getting, buying opportunities driven by sell-offs. So that to us would be the balancing act to play here. And that's why ultimately on balance, while we prepare for short-term volatility, we would still sort of maintain an optimistic tilt and look to use any sort of pullbacks and saying where are those opportunities to buy. We think India should benefit as part of a broader rising flows towards Asia and emerging markets. I think it's just about persisting through the near-term uncertainty.
Okay, all right. So maybe slightly weaker US dollar will be the silver lining of all of this as we get into the second half of the year. Manpreet, great conversation. Thank you so much for joining in and giving us perspective on these very, very uncertain times. Well, as we wrap up this edition of the Global Reset, let's listen to views coming in from a whole host of experts, both people expert on geopolitics as well as trade and economy experts, on what the US-India trade relationship looks like right now. Thank you for watching.
On the Indian side, this thing has also been largely post-partisan for the last couple of decades. But in the face of these threats from President Trump, his statements, his actions, and his tone, what you see is the media, the Indian public, and the opposition pressing on the government not to show any weakness. And I think even if they reach a tariff deal, which I think ultimately will be likely, the trust is gone. And this thing is back in the middle of domestic politics in a way that can be spectacularly unhelpful.
No, I do think that the 35% tariff and the threat of more is really not justified. Now, if Europe, the EU, can get away with 15%, the UK with 10%, Japan is 50%, why would India pay 25%? The only possible justification is that India is also a high tariff country. But that should have led to negotiations for India to lower its tariffs without getting 25 and then a possible secondary sanctions imposed on it.